Thank you so much for joining me on the Storage Syndicate YouTube channel. I'm Thaddeus Campbell, as always, here to talk all things self-storage. The big news in the industry right now, we just got the numbers for 2022, and the Self-Storage Association released that the average trade of a Class A self-storage facility happened at a 4.61 capitalization rate. So divide 100 by 461, you come up with a little over 20. The average purchase of a Class A facility was for more than 20 years worth of net operating income of that facility. Those are historically low cap rates, historically high purchase prices. But keep in mind that many of those purchases happened in the first part of 2022. Jerome Powell and the Fed did not start their aggressive campaign to raise interest rates in an effort to quell inflation until May of 2022. So the big question on everyone's mind, especially us as developers, is what happens as we see rates. They just did another 25 basis points this week as I'm filming this segment. What happens as we're seeing the Fed's benchmark rate now in the mid-4s, mortgage rates in the 6s, 7s. I'm even seeing construction loans, especially on someone who's getting high leverage on their total cost. Someone's getting 75, 80% on a construction loan. They're paying in the mid to high 8% on their debt. So the question is, how long are we going to see these type of historically low cap rates as long as we see the rising cost of borrowing capital? Ostensibly, there's going to be a direct correlation between those two things. As somebody's ability to go and secure debt costs them more, they're able to pay less of a premium to buy a product like self-storage. So we want to be very careful in what we're investing in at this point. We have to prepare for some worst case scenarios where, for instance, we just got a report back, we've done our due diligence, we have a feasibility with a pro forma based on our projections from multiple sources that we trust on a site that we're looking to develop, and we're projecting it's going to cost us $15 million all in. That's the cost of the land, the cost of the construction, the cost of the debt. That pro forma at a 5.5 cap, which we would consider conservative right now, right? These have been trading at a 4.61 cap. If we judge this at a 5.5 cap, it's projected at stabilization when it's filled with renters and they're paying a normal price for that market to have a value north of $29 million. At 4.6 cap, it's well over $33 million, but we're not going to get too aggressive in our underwriting. Here's the problem. What happens if all of a sudden, instead of getting a cap rate at 5.5, all of a sudden 3-4 years from now when we hit stabilization, we're seeing cap rates of 7.5, 8, or 9, a reflection of the rising cost of debt? Well, there's a couple things there. Number one, if we do see that kind of incredible spike, we haven't seen, by the way, interest rates in this range since back in the 1990s. It's been well over 20 years. From 2000 all the way through till today, we've never seen anything approach double digits like we're seeing right now. So we have to be prepared for what that outcome is going to look like. Here's the bright news for self-storage. We have a 40-plus year track record of consistent 8% revenue growth year over year, right? Our projections for these projects are at 5% revenue growth. And one thing we are very cognizant of in this industry is if we're going to see these spikes in interest, we still haven't seen the full effect of inflation on the rates we're getting. So when we're underwriting a project like this, we're using a very conservative number for what we expect to get for rental rates in that unit. And if we simply on this project at an 8 cap, it's going to be worth $20 million at stabilization. That's a great number for us. We know that if our total all-in cost is $15.2, even if we have some cost overruns and it costs us more money, at least the value of that property, if we have to go and sell it in order to get out of it, we know that we have a high likelihood of being able to sell it for a value greater than what it's going to cost us to build. That is a great negative to look at, right? If our worst case scenario is cap rates go to an 8, even to a 9, and we go 10, 15% over budget, we're into this project for 17, 18 million. We know we can sell that project and recoup the money that we put into it for construction and lending any money we lent. Obviously not the outcome we want to have, but we're protecting ourselves from that back end risk to make sure that we have that ability to have an exit. And of course, we want to make sure we're taking care of our investors in a worst case scenario, right? Now, best case scenario, we're still able to sell this facility at a 4.6 cap in 3 or 4 years when we hit stabilization. At a 4.6 cap, it's worth $34 million. It costs us $15 million to build. Everybody wins. Please, if you got anything of value from this, hit the like button down below. Subscribe to our channel. We are consistently going to bring you great content related to self-storage. Check out our website, storagesyndicate.com, for more information on our group. And we look forward to bringing you more info on the self-storage space very soon.